Welcome everybody to a very interesting session at the Institute of International Economic Policy in George Washington University on modernizing and reshaping the World Bank. I think Archimedes said it best: give me a lever long enough and a fulcrum, and I can change the world. And can the World Bank become Archimedes' lever to help change the world? That is the question that we have a very distinguished panel today to talk about and discuss with you all participants as well. A new incoming president has been nominated, Ajay Banga. A kind of a initial reform plan of the World Bank has already been presented to the Development Committee and the board of the World Bank. So we thought this would be a great time to have three very knowledgeable experts on the World Bank, three people who have actually served in very senior positions in the past in the World Bank and then have gone on to bigger and better things, to come back and give us their views on how the next 5 years, next 10 years, maybe the next 25 years next of the World Bank can be, how the World Bank can be reformed to help reshape itself and become a more useful player for the many challenges that the world faces today that we are all well aware of. The way I look at it, there are three buckets, if you like, of problems. One is, of course, the big issue that's been making the headlines is how to make the World Bank a bigger player on climate change, on climate finance. Al Gore, the former Vice President Al Gore and Nobel Prize winner, said it in some very strong remarks that the World Bank is missing in action on climate change. How to bring that in while also addressing issues of poverty and shared prosperity, and whether there's any kind of conflict between those objectives, I think is one big issue that I hope the panel will address, and I'm sure they will address. The second big issue is, of course, its financial model of the World Bank. Many people feel it's quite outdated. It's more like a 20th century model. What we need is a 21st century model, which allows the World Banks to use its capital base in far more innovative ways to leverage in more private capital to address the challenges, not only in the developing countries, but across the globe as well in terms of global public goods. And lastly, the World Bank still remains very much, as I said, it's in its governance structure, a 20th century bank. It was set up, in fact, during the Second World War, and its governance arrangements have not changed very much. It's not even relevant. Its governance structures are probably not even relevant in today's changed world, let alone where the world will be 20 to 25 years from now. So these are the three sort of buckets of issues that I thought we would have our distinguished panel address. Today's panel has Nancy Birdsall. She has had a very distinguished career at the World Bank, and then at the Inter-American Bank, and then she established the Center for Global Development. She's I think the President Emeritus of the Center for Global Development. So welcome to you, Nancy. Then we have Ana Palacio. She also had held very senior positions at the World Bank as head of its legal department, then went on to become the foreign minister of Spain. She has a CV which is a mile long. You can read it. She's a very distinguished legal expert, but also knows a lot about energy and climate finance, as you will see from her CV. And last but nowhere least, we have Johannes Linn, also had very senior positions at the World Bank, in research, in operations, as well as in the finance complex. He also has had many great things that he has done since leaving the World Bank. Is now at the Brookings Institution. So welcome to you, Johannes. So let me first turn to you, Nancy, and then we'll follow with Johannes and then with Anna. Then I'll come back and open it up for discussion. Nancy, over to you.
Thank you very much, Ajay. It's a great pleasure to be here with Anna and Justine and you. I think we are all experts on the World Bank. Washington is full of experts on the World Bank. So I have 3.5 points I want to make. The first one does have to do with governance, and it is something that's bothered me for many years. And it is that the World Bank is the only major international institution where there is absolutely no clarity and usually no competition in the selection of the president of the World Bank. There is no pretense even of that selection being the result of an open, competitive, and transparent process. That's the language that's been used for many years. All the other positions that I can think of have competition among countries, at least. It's not so much among people always, but it's among countries. Countries try to find good candidates that will win out in a competition with other countries in who should be the head. Now, this matters a lot because it has to do with other weaknesses in the governance of the World Bank, which is that the board itself is a relatively weak institution. The president of the World Bank is the chair of the board, and there isn't really any way that a board can hold the president accountable. We can talk later if anybody wants to about how it has happened at times that a president has been held accountable, but it's usually because of extraordinary and unpleasant circumstances. So I personally benefited from this peculiarity in the case of the Inter-American Development Bank, where there is also not really any competition or any openness about the selection process. The way you become the executive vice president of the Inter-American Development Bank, which is the position I held, is that it's the deputy secretary for international affairs in the Treasury at the time when there's an opening, basically looks around and finds a good person. Sometimes there's pressure from Congress and so on, but that's what happened in my case when Larry Summers was the deputy for international affairs at the US Treasury. So today we're waiting to see, as you said, Ajay, what kind of a leader Ajay Banga will be. I think there are good hopes that he'll be forceful and charismatic, that he understands financial issues, that he's a good manager, but we really don't know. It's a little bit of a crapshoot. Let's wait and see. So that's my first point. I hope others will comment on it, other of the panelists, perhaps. Anna in particular, maybe. My second is about climate. As you mentioned, Ajay, this is the issue on the agenda today for the World Bank, how to retain the same leadership and the same forceful efforts and resources that now go to development and poverty reduction. And the second prong of the World Bank's efforts, decided on some years ago, called shared prosperity, how to add to that two-prong mission of reducing poverty and helping countries grow in healthy ways, and doing it in a way that minimizes income inequality and maximizes what is called shared prosperity, how to combine that with climate. And the problem, of course, is a very straightforward one. In fact, many years ago, I think it would have been in the late 2000s, Bob Zellick was speaking at the Peterson Institute for International, I forget what it is now. Anyway, the Peterson Institute. And it was a big crowd. And when questions came, I asked him about climate. This would have been about 2009, 8 or 9, I think. And he was very clear. He said it's very hard to do because the low-income developing countries, well, all developing countries, but the low-income countries in particular, worry about additionality. That is, if money goes into the World Bank to deal with climate as a global public good, that is with climate mitigation, that will be, it's hard to see how it doesn't reduce what could have been added in terms of capital or concessional funds to the World Bank to deal with poverty, especially in the low-income countries. So this issue of additionality haunts the whole discussion of what to do about climate at the World Bank. I'll return to that in a different way in a few minutes, but let me just say here that the only way to deal with that tension is to have enough big new money somehow on the table in the next year or maybe more, but ideally very soon, so that it's clear that the constraint is not resources to deal with either climate or development, but narrowly conceived, but the capacity of the institution to do things about those things effectively, and the absorption capacity of developing countries, low income and middle income. So it goes back a little bit. We're already back on the question of leadership, how that might work. But with leadership at the bank, it is possible now to raise a lot of big money in two ways I'll mention. One is to push hard at the international level on the special drawing rights allocation that was made now a couple of years ago, where rich countries who don't need these special drawing rights issued by the IMF as liquidity for the global economy would reallocate them to developing countries in some form. And it's very complicated and very technical. We could have a whole session on just this issue. But the bottom line is, as was the case with dealing with debt of developing countries during the Brady Plan in Latin America and the HIPC arrangements at the time of the Jubilee movement in 2000, at the World Bank, it is possible. It just takes leadership and negotiations and pushing and prodding. Very difficult in the EU because of certain rules. But let me just leave it at that for now. That's one source of new resources. I think an even more, bigger potential sooner and more easily is related to the report of the G20 on the capital adequacy framework, which raises, for those of you who aren't aware of it, it's about finding ways to increase the leverage of the World Bank, and actually could be the other multilateral development banks as well, to sweat the capital that exists there more, but also to call on more of the actual resources that the World Bank has. That report emphasizes that the preferred creditor status of the World Bank and the other MDBs is not being exploited fully. And it emphasizes that the reality of callable capital, being a large pool of resources, is not being exploited fully. I don't want to try to go into the technicalities of these things, but the bottom line is for listeners that the World Bank has very low leverage compared to any commercial banks in terms of its use of capital for lending. Recently, there was a reduction from 20% to 19%. But with the cap, if these ideas raised by the G20 working group were implemented, it could mean really you could get to $1 trillion more a year, either and or for climate mitigation lending, and for concessional resources for development, and for capital lending for development. It's about also, if participants may have questions about dealing with the rating agencies, other technicalities. The point, though, is finding big new money. It requires negotiation at the most senior levels across the board in the global system. So here we look to leadership from a president to take on what the report called calculated new risks. Let me go to the third topic I wanted to raise, which is global public goods. I call it part 2. And that's how might it be set up inside the World Bank? And my colleagues, Charles Kenny and Nancy Lee at the, I think it's Charles, no, and Scott Morris at the Center for Global Development have suggested something that's related to something Scott and I suggested in 2015-16, which is to have a separate fund. It could be a capital fund with separate governance that is related to the contributions of capital put into that fund. So think of it as a green capital fund that would be housed at the World Bank. And as in the case of Bretton Woods, 50 plus years ago, the number of shares and the sort of voting power that a country has in that fund would be related to its initial and subsequent capital contributions. This is a great idea, both because it's a fresh start, where I believe China, for example, India might be persuaded, but particularly China, to take a lot of leadership. And just as the US could and did in 1946 at the World Bank. That's one reason. The second reason is that this fund there could be decisions about its deployment. Charles Kenny has this great idea that it be used primarily for policy loans, because the developing countries are complaining with justifiably more and more about the tedious and long process at the World Bank in getting a loan. And there's a lot of concern that even for access to climate mitigation and adaptation money, but I'm talking mostly about the global public good of mitigation, there's a lot of concern that it'll take 3 or 4 years to get a loan out of the World Bank, and that the environmental and social safeguards we know adds a year alone to negotiation of a loan. That shouldn't happen with a green capital fund. And the suggestion from my colleagues at the Center for Global Development is that it be focused on policy loans, quick dispersing policy loans. They can be sort of dispersed, as is traditionally the case, in response to actual notable fixes or changes in the way that the resources could be used. So it's an opportunity with respect to China, and it's an opportunity to be much more responsive, especially to middle income countries, about processes inside the World Bank to secure a loan. So how am I doing? Do I have another minute?
Yes, please, 1 minute.
Okay. So, so this is number 4, and it's about climate indirectly, but it's mostly about migration. For decades, the World Bank has not supported international migration in any form. That reflects the reality that it's a very sensitive subject certainly in my country, the US, but in Europe as well, in general, among the largest, richest shareholders at the World Bank, international migration is not on the table as a development, as a route to development and poverty reduction. And that is despite the evidence very clear at the individual level that migration from a poor to a rich country makes you immensely richer by 300% to 2,000%, depending on the country from which you come. And that's from very careful studies, taking into account differences in backgrounds of people and, using econometrics to make sure that this is the same person in terms of education and health and background and so on, as you make that person, that young man, equivalent to the young man in the US with the same education, same background. So it is, as my former colleague, Michael Clemens said, the world is leaving trillions of dollars in improved global welfare on the sidewalk, not being picked up. So why is this urgent now? Because climate change in developing countries is going to generate new waves of migration, not only to rich countries, but to other developing countries. The fact is that the World Bank has made a little tiny, teeny step in that direction already in the case of concessional support to Lebanon and Jordan, I believe it was, so starting some years ago, for migrants to those countries, which those countries are particularly burdened with very large waves of migration, I guess, from Syria.
Right.
Okay. So climate change is going to make a difference. And there is already something called the Global Concessional Financing Facility at the World Bank. President Jim Kim went around with the begging bowl to put money into that facility to reduce the borrowing costs of Jordan and Lebanon that for use in supporting refugees and migrants in their countries. So let's call that, something under a green capital fund that could be thought through. Thank you very much, Ajay.
Thank you. Thank
I'm
you.
looking forward to comments.
Nancy, absolutely. And just to say that we had Muhammad Yunus from Bangladesh the other day speaking at GW. And, Bangladesh is doing relatively well in the developing world. And we asked him what would happen with climate change. And his answer was climate refugees from Bangladesh. So thank you for that very rich set of comments. I'm sure it's going to generate a lot of questions and discussions, including perhaps from our next speaker, Johannes Linn. So over to you, Johannes.
Thank you, Ajay. It's admirable how you set us up. So let's see how it goes. Okay. I think I'm going to rejoin on one point that Nancy made, and I may be the skunk at the party, as I said early on that particular point. But before I go there, let me say that I'm absolutely delighted that the World Bank is asked to do a lot more. Nancy may remember, I certainly remember that there was a time when the big slogan was 50 years is enough for the World Bank. That was back in the early to mid 1990s. And it wasn't just that we had this argument about the bank should basically work itself out of the job. We didn't have that only outside the bank. We actually had a big argument inside the bank. I don't know, Nancy, whether you remember. There was a debate between a call for the sunset bank, that the next 25 years, basically, the World Bank should work itself out of a job and disappear. And on the other hand, what we called, Amar Bhattacharya and I in particular, called the Sunrise Bank. Namely, that indeed there are lots of jobs that are out there the bank could and should be doing. I can't remember whether we suggested global public goods, but I think we probably did. Amar, if you're around, let me know. Anyway, I'm delighted to see that everybody basically is now talking about how to get a Sunrise Bank. Yeah, there, by the way, was later on also, of course, sort of a push of sorts, although the name was not really that popular for good reasons, to push the bank to become a poverty bank, and particularly basically get out of middle-income countries, especially upper middle-income countries. And, you know, Nancy, my government, the US, was among those who pushed quite hard for that. And not only in the bank, by the way, also in other fora like IFAD. I remember replenishments for IFAD that I chaired, and every time there was this argument, get out of upper middle income countries, you're not needed there. Well, today, of course, the US is pushing for just the opposite. You know, World Bank should be more active in middle income countries. So I'm glad to see this. In fact, as far as I'm concerned, the more the better for the World Bank, and by the way, other multilateral development banks. The multilateral system is really critical nowadays. So I'm not going to focus on the details of the what and, you know, exactly how much, but really on the how, and particularly on the financial side, because Ajay actually asked me to focus on finances. During the Q&A, I'd be happy to talk lots of other things that the bank could and should be doing maybe differently, but let me focus on the finance side. Clearly, as Nancy indicated, we need a lot more money, because with all the additional things, and to avoid precisely the tension about the argument about additionality, more money is needed. Now, Nancy set it up. She said basically there are two ways of doing this. One is to generate more capital, which you either do with a capital increase in the additional way, or maybe through SDRs in a non-traditional way. And you know, that takes time. And so in the meantime, let's push really hard to sweat the capital of the World Bank. And that's basically what the argument is about. And, you know, Madame Yellen already has put her foot down, saying, we're not going to increase capital, at least not for now. Let's not even talk about that. What we need to talk about is basically how to squeeze more out of existing capital. Now, I think that's important consideration, but I think we need to be very careful on this and make sure we do it the right way and do it only to the extent appropriate. Now, Nancy already referred to the expert task force of the G20, which concluded that there's several hundreds of billions of dollars out there in additional headroom to be had by sweating the World Bank's capital, sorry, the MDB's capital, not just World Bank, which then has gotten translated. The report doesn't mention these specific numbers, into 500 billion to 1 trillion. Exactly what you just mentioned now, Nancy, is out there as what can be had basically as a free lunch by just taking a little bit more risk here or there, maybe. This is including an OECD publication. So that's the number out there, 1 trillion. That's for the expectation we've created of additional, basically free money that's sitting there to be had. Well, as I say, as skunk at the party, I don't believe that's the case. And now, while I'm all in favor of having a capital adequacy review, and indeed the report had a lot of interesting suggestions how to particularly be innovative in the financial instruments and the financial domain with hybrid capital, leveraging private finance, and so on. I don't think that the analysis on capital adequacy was complete, and hence I don't think the core of the analysis and of recommendations is, I believe, is seriously compromised, especially with regard to expanding the headroom of the MDBs. So let me spend a little time, and yes, it is a bit technical, I'm afraid, but this is really important, Nancy, and I think it's very important for everybody that we understand this and understand it correctly. So the central argument of the G20 report is that the MDBs treat callable capital too conservatively, and that they should indeed count some of the callable capital towards regular capital by giving it what's called a lift that allows you to actually go further in the use of your regular capital than traditional analysis of just regular capital, which is, by the way, paid in capital plus reserves, would allow you. Now this, if you were to give this lift, the argument goes, results in a significant increase in headroom while still maintaining your AAA rating, which the rating agencies provide. And indeed, after all, that's what the rating agencies are looking at. And indeed, the rating agencies themselves, so the argument goes, provide this kind of a lift from callable capital to support the AAA rating. Well, what the report doesn't mention, I think that is the critical omission, is that protecting AAA is not the only part of the capital adequacy story. You also, very importantly, need to protect against the call on capital. Now, of course, the MDBs should maintain their AAA rating, and I'm delighted to see that the G20 report supports that, because there are actually voices out there that said, no, you can go to single or double ratings, no big deal. Because, of course, the bondholders are being assured with this total capital stock, callable plus regular capital, assured that they'll be paid back. And this is what the ratings are all about, that the bondholders will be paid back. So AAA rating, all capital available in principle, at least, to pay the bondholders back. So this is what the ratings are about. This is what the rating agencies assess, and the rating agencies rightly. And by the way, the bank's financial analysis also, in assessing its ability to maintain its AAA rating, looks at total capital, not just at paid-in and capital and reserves. However, in addition to worrying about whether you're maintaining your AAA rating, you also have to worry as a financial manager. And for 5 years, that's what I worried about as the Vice President for Financial Policy and Risk Management. You have to worry about the risk of a call of callable capital. In a crisis, when borrowers were not to repay their loans, you may be ending up in a situation where your regular capital is not sufficient, and that then requires a call on capital. Now, what happens when you have a call on capital? Well, it turns out we don't really know. There are no clear provisions for what happens in the case of a call on capital. It'll take a lot of time of negotiations among countries. It'll take time within countries. Think about the US has a total callable capital committed of $47 billion in the world in MDBs. So far, the Congress has only approved $7.7 billion. So basically, the administration would have to go back and just imagine in today's world what that means in order to squeeze out capital out of Congress. So this is going to be a long, protracted process until, indeed, if at all, you're going to get that money in. And I think, yes, in the end you will, but it'll take a long time. Now, what will happen in the meantime? Well, basically, the MDBs, the World Bank, will have to shut down. They'll have to stop dispersing. They'll have to stop making new commitments. And moreover, the basic model of callable capital will be called into question because, you know, the whole assumption of callable capital and capital increases with callable capital is indeed, and that's why basically Congress will allow it, is that it will not be called on. And the whole financial management of the institutions is based on the assumption that you protect callable capital. And that, unfortunately, that whole aspect is something that is not treated in the G20 report. And hence, while I think, yeah, it may be, we in the financial management community have been too conservative in assessing whether or not a call on capital is likely or when it is likely. But if you base your whole analysis and your recommendations of $1 trillion increase in MDB lending on, in my view, an incomplete, at best incomplete understanding of how the system works, I think we have a problem. And so, yeah, I mean, shareholders may want to take greater risk of a call on capital than the financial managers traditionally recommended. But let's be clear, this is not about a lift from callable capital that sort of allows you to do more with your regular capital. This is about whether or not countries and shareholders are willing to increase the risk of a call on their callable capital. That's what it's all about. And that's actually, as far as at least in the case of the World Bank, is, I believe, the critical constraint in terms of what is available for headroom. Now, my own advice there for shareholders and, of course, for the new president of the bank is not to swallow the G20 report's recommendations, especially on capital adequacy, how to use callable capital, hook and sinker, but be very careful. And I think there's some special reasons, Ajay, if I have a couple more minutes, to be very careful these days. First of all, there's the implicit assumption in the G20 report, and by the way, it's made explicit in a number of blogs and what have you by members of the task force. The implicit assumption that financial managers and managers more generally of the MDBs have an incentive to be very conservative, rather than instead rather argue for capital increase instead of squeezing their capital. Well, in my experience, that's not the case. First of all, we know from banking more generally that in the absence of good regulations, bank managers tend to be taking too many risks. I think that's true in principle for the World Bank also. Indeed, in my experience as a financial manager in the bank, I found that I had to continuously argue with the board, continuously argue with senior management about what is about how far to go. There was always pressure on going further in terms of lending more, because arguing and going for capital increases is a very protracted and very painful process for any organization. So the tendency, as soon as there's signal out there that the shareholders are willing to let you go further with the exec, the management would do it. And you saw exactly that happening. So I think it's a very risky proposition to basically say, well, there's all this 1 trillion out there and just go for it, because I assure you the managers will go for it, as we already see. And the question is, where will you stop? Well, you'll stop once you actually run your organizations into the ground. So that's let's be careful here. The second reason is, yes, Nancy, you mentioned the preferred credit status. Well, I think the report is overly optimistic on that score. In fact, the preferred credit status of the traditional MDBs has been eroded over the years, because you have many more multilateral banks and institutions now claiming preferred credit status. And now, most importantly, most recently, China has actually called into question the preferred credit status. So, I don't think that's ironclad. Third reason why to be careful, I see your face, you want me probably to stop and shut down, I will.
No, it's fine.
Is that the rating agencies are this report says are too conservative in their assessment. Well, don't we remember that the rating agencies were actually attacked for having been too lenient in the run-up to 2008 and recent crises and what have you? Well, why would they be not too lenient and instead err on the other side for MDBs? I don't get it. Fourth reason why I think we need to be very careful is remember that the MDBs are the lenders of last resort in the time of crisis, and they need to be especially resilient. Do we really, at this stage, where we have banking and financial system in some sort of crisis at the moment, where we have the US Congress messing around, and we don't know where we're going to be in June and July in terms of the world's financial system. Do we really want to weaken those few institutions that are truly strong at this point? Well, I'd be very careful. So my bottom line is, I don't see how you can squeeze $1 trillion, no way, out of these MDBs, or for that matter, out of the World Bank. The only solution, in my view, is if you want to, and I think we should, aim for a much bigger World Bank and MDB international multilateral financial system, we have to bite the bullet and put in more callable capital, callable and paid in capital, or go the solution of SDRs, or figure out whether or not hybrid capital is indeed feasible. And I'm happy to see that the World Bank actually currently is undertaking a pilot on hybrid capital, and let's see how that goes. Thank you very much.
Thank you, Johannes. Yeah, well, we certainly wanted a good debate, and we have it. And just to say that my own experience as World Bank in the operations department, I felt that both the financial complex and the legal department were very conservative. I'm saying this to provoke Anna, because I'm going to turn it over to Anna now. And I'm glad that this debate is on. I still remember being in Madrid at the 50-year bank fund meeting. 50-year, it was actually in Madrid. That 50 years is enough was taken. And so today we have Ana Palacio straight from Madrid to speak to us also on how to take this forward, how to take the World Bank forward. Ana, over to you.
I'd say, first, thank you. Thank you for inviting me and having me sharing this fascinating discussion. And the problem is that we don't have all the time we could spend discussing. So I will try to be telegraphic. First, you have provoked me. Conservatives, absolutely, we are. As Senior Vice President and General Counsel in those days of the World Bank Group, so including the IBRD, IFC, and all the different just the constellation of the World Bank. I would say that an institution like the World Bank has a duty to be conservative. I'm sorry. This is the nature of the World Bank. And on this, I fully agree, and this allows me not to touch upon this aspect of financing, but I fully agree with what Johannes has said. For the World Bank, having a AAA is an objective. It's not a circumstance. It's part of the of the Articles of Agreement. I mean, it's part of the duty of the World Bank. And I fully agree with him that because of governance, and I will just go into it a bit further down, but because of governance, and because in the end, the World Bank is owned by the management today, by the management, by the World Bankers, not by the president, and certainly not by the board. Yes, I fully agree with Johannes that we have to specifically careful not to go into adventures, and I fully agree that the figures that are being debated are really pie in the sky. Now, it's a pleasure, Nancy, to have you. And first thing that I have to highlight, you haven't brought a term that I frankly cannot understand how we still use it, which is poverty alleviation. You have said what it is to have to be said. Poverty reduction. Poverty is not an incurable chronic disease that you cannot change. Poverty has to be reduced. So on this, absolutely in agreement with you. On the competition, on how to select the president, I will touch it later because this is a central issue. Now, I would like to address on this idea of having a separate fund. Frankly, again, Johannes' intervention, we need political commitment to disburse money. And as far as we remember, the 100 billion commitment for energy transition for developing countries for the global south that was agreed in 2009, it had to be remembered by the recent G20 meeting in Japan, the ministerial meeting in Japan, that is still there, has not been complied with. I know there have been disbursements that we can account for, but frankly, I think that a separate fund is an idea. It's an interesting idea, but the driver of the message I would like to bring to this conversation is that we have to be realistic. We have to be ambitious, but also realistic. And you have asked me to address, preferably or primarily governance. But the thing is that in the World Bank or in any other entity, the governance is not a public good in itself, although good governance is, but the shape and type of governance, it's linked to the goals, to the core goals. If we have an institution centered on financing, you need a certain kind of governance that is different if you focus on transnational financing linked to climate change, for instance. And of course, at the World Bank, we have a very powerful aspect of education, capacity building, and general poverty reduction that do not fit in any of this. Yes, we have seen that both the US and from a different lens, the Europeans are pushing towards a stronger emphasis on global public goods, as Nancy has reminded us, and a cross-border approach, which is, as opposed to what is mainly the focus of the World Bank, which is country-specific, country-centered. I'm not going to repeat the declarations of Janet Yellen that the bank has to evolve to be bolder and more imaginative. Yes, of course, but and this just goes in the same wavelength of the European, which is the standard bearer of the green transition, and have been equally vocal. And there is this letter published in October 2022 that the World Bank has to address global crises such as climate change. So it's clear. And of course, you have mentioned the capital, and if you add up European Union plus UK plus Nordics plus United States, well, there is a majority, and the bank could propel, in theory, the bank in this direction. But honestly, in my opinion, there is, yes, a compelling case to refocus the bank core tasks. But where is in it the African voice, for instance? Because developing countries which face, and we know that, mounting development challenges and prospects of another lost decade, want the bank to lend more for traditional national developing programs. And while they are interested, as we are, in global public goods and transnational approaches, they face other urgent challenges that require immediate attention. And you have mentioned, and energy transition is a good example. We are in the fight against emissions, but sometimes, especially we Europeans, we tend to go too dogmatic and forget the reality of energy poverty. There is, in Africa in particular, there is a resentment and an accusation of double standards that is not any longer subdued, that is in the open. A friend of mine from Mozambique put it in a very nice way. He says, Anna, we are the first to acknowledge the need to decarbonize, but in order to contribute, let us carbonize first. All sub-Saharan Africa just counts emissions. If you exclude South Africa, less than 1%. So we need to take this into account. Do we want to push forward an agenda the way we see it, or are we going to listen to, and I put in the front line, not that in Latin America or in Asia, but the area of the world that is within the realm of the activities of the World Bank, where you see this in a more acute way, is in Africa, and especially in sub-Saharan Africa. And honestly, on this, I join Johannes. There is not enough money right now for climate change, the SDGs, and this projection of additional 2.5 trillion. Well, you know, these are the projections that are out there to reach the Paris Agreement climate goals. So this amount yearly until 2030. I think that we need to bring realism about what we can do, because even if we speak about just about climate change, there is a growing tension between funds dedicated to mitigation and funds dedicated to adaptation. Efforts in one of the channels and efforts on the other. And frankly, this tension is especially acute in the countries you mentioned. No, it was Johannes, or it was you that mentioned Bangladesh. Bangladesh is a case in point. Yunus is saying that, of course, there will be, and you have said it, and it's absolutely clear that there are displacements in the first place, cross-country migration, and there we, European Union, you Americans, we have to remember that this migration happens between developing countries, that we receive a tiny minority of this big amount of people that are forced to displacement within countries or just that cross borders. For us Europeans, there is a very telling kind of parallel in Africa that you see when it goes the dry season, the lack of water goes up and down, and you see the influx in South Africa and the influx there. Now, the other day you hosted Ajay Banga at the Center for Global Development, and it was a very, very interesting, very interesting conversation. What he said is clearly that math is not on the bank side, and that the bank cannot do it alone. And I'm paraphrasing, but even the generosity of governments and philanthropies and the work of other multilateral banks together, the World Bank is going to fall short of the trillions which are necessary. And what he called for is the participation of the private sector. Without the private sector, we can reach no results. Now, I think that what was interesting in this intervention, but also in a survey or that you did at the Center for Global Development is about China. I will just go very fast over it, but what it says is that in 100 contracts across 24 developing countries in Africa, Asia, Europe, and Latin America, China is the top lender. So, I mean, it matters how China approaches. China is clearly establishing itself as an emergency lender via its central bank. It's a lender of last resort. So again, I think that we see how we are not there in the possibility of having. We have already a parallel set of institutions from the Belt and Road to the Asian Infrastructure and Development Bank. So now, what about the governance in this context? Well, we have to remember that the bank has undergone already shifts. It was created for reconstruction. It was reinvented mainly by McNamara when the waves of independence, new independent countries were reinvented by McNamara as an instrument of the free world in the context of the Cold War to allow these countries to have a market economy, to access the international capital market. But today this capital market is completely changed, and it's true, you are absolutely right that it has, the governance of the World Bank is still the governance created at Bretton Woods, basically. Now, the thing too is that the governance of the World Bank is the whole structure. So it's also the management of the World Bank. In reality, with a board that is weak and a president that is needed to be extremely strong and have strong ideas, you still have the core of the world bankers that is there, and that you have this fantastic history, first-rate history over the 70 years, but also certain inertias that are not easy to to change. So before we discuss, and I will say a couple of words on how you select the World Bank president, in my opinion, it's right. You are absolutely right that in the world of today, it doesn't make sense that the president of the World Bank has to be an American, and at the helm of the IMF, we have to have a European. It doesn't correspond with the world of today. It did after, or in 44 in the Bretton Woods conference, it doesn't today. But for me, this is not the most important issue. I think that what the World Bank has is to evolve in its culture, to understand that what is needed is an overhaul of the modus operandi. The bank, and you have mentioned that, has been criticized, and rightly so, for being too slow. It's there. We have this issue, but it's complicated when it comes to international institutions without having a very clear commitment of the shareholders that address this issue. I will say that from the intervention of Ajay Banga at your center, what I picked up is the importance that he gives to digital technology. And I think that this will be the mark of the hallmark of his mandate. So I will conclude by saying that we need more commitment of the members of the World Bank, a clear vision, but also a realistic vision that we have an institution that has an extremely good track record, 70 years of track record, and that needs a strong head that will make happen this commitment of the shareholders. And I will leave it there.
Thank you so much, Anna. Thank you so much. So this is more to the participants that you can see we are in for a very rich discussion, and we would like to get you involved into this discussion as well. So please start posting your questions on Q&A, and I will pick them up as we go along. But while you are doing that, let me just throw it back a little bit to the panel with two sets of issues. And if you keep your responses short, I think we can have it more interactive. One is that the way you framed it, it was like poverty, shared prosperity, and climate change. But when you actually look at the reality on the ground, those things are highly interrelated. You cannot deal with poverty. The poorest people are getting hit the hardest. You really cannot deal with poverty unless you address the climate issues. And why do we need another silo called climate change, and why can't we find a more holistic way of addressing these issues? That's one set of questions that I had. And also, while I may agree on that the CAF report, as it's called, perhaps didn't go deep enough, I do feel that there are already instruments in the World Bank arsenal that are grossly underutilized to leverage private capital. I'm talking about guarantees and insurance instruments, which when I first tried to use the insurance instrument in Turkey, it was like pulling teeth in the World Bank. So why is there not more innovative use of these already existing instruments as we look for resources from outside? So let me just throw this back a little bit, and while I wait for the panel to put some more interesting questions out there. So back to you, Nancy. Let's see.
Okay, yes, on your two issues, quick thoughts. Why another silo? Well, it's a little bit like saying, if you had said, when was it, back in the 50s or early 60s, why an IDA window when we already have IBRD? Well, there are good reasons. It focuses the mind. In the case of climate mitigation, it's an opportunity to change for that issue, but also for the World Bank as a whole. It's a little tweak in the governance of the bank. It's an opportunity to bring in countries, including China, including India, who would have a bigger seat at the table, period. The US might not get around to doing much about it because we have our complications in our own governance here. So yeah, let's see what happens. I think, you're absolutely right that all these things are interrelated. Particularly the point that Johannes or Anna made, maybe Anna, about energy poverty. Absolutely. It's absurd that we are even talking about punishing countries in Africa somehow if they do high emission projects. No, we should be providing, lower emission projects. There's a lot of people talking about this. A former colleague has founded, Todd Moss has founded a group that's very grounded in the Africa situation with staff from Africa and an office there that's saying exactly what I think Anna said, or I can't remember. So that's on that. This is absurd. There should be lending to Africa for low emission energy projects. I think the issue of the private sector and the failure of billions to trillions, for any listeners who don't understand, the idea was we're going to have billions of public money leveraging trillions of private money. It is all about the unwillingness of these institutions to take even a little more risk with guarantees and so on. I fought at the Inter-American Development Bank Barbados wanted a guarantee instrument. And I was the executive vice president. I was chair of the loan committee. And there was no way. There was no way. At the IDB, when I was there, as far as I could understand, and please don't quote me on this, out of context, the key goal in the Treasury portion of the IDB was to keep its borrowing costs within 4 basis points. This was at a time when it was below London, rates, below, no more than 4 basis points more expensive than the World Bank. Now, that's been transformed at the IDB, which has indeed already taken up some of the issues around that are suggested in the capital adequacy framework of the G20 report. It already has worked with rating agencies to, raise the issue, how do we keep our AAA and call on a little bit of the callable capital. This is a very complicated issue. We can't really, and I am not an expert on it, but there's no question in my mind, this has been going on for years, that these banks, these multilateral banks, fail to adequately sweat the capital they already have. They're doing better. The IDA finally borrowed on the markets using its equity in the form of repayments. And the IDB has gone a little bit farther than that. So that's where we're going. I think, some of the issues that Johannes raised are worth thinking about, but the general direction has to be greater leverage of these banks. Otherwise, it's, we can't address these global issues. So,
thanks.
Ajay, I have raised my hand because
Anna,
it might be perceived as contradictory with what I said at the beginning, and it is not. I fully agree with Nancy saying the World Bank has to accept taking more risks. Now, the difference is that one issue is the institution as an institution, and then what I mean, the World Bank is a fantastic institution. If it did not exist, we should create it, but with two caveats. The first is that world bankers are risk averse in their behavior. How many times have I had to sign on a paper because my colleagues in my team would tell me, no, but we don't have all the receipts. We are missing this paper. We are missing that. And, you know, I think that the culture of the World Bank inside the culture of the world bankers has to change, and without not going as far as giving a premium to risk taking, but yes, addressing this in how the management as individuals belonging to the management. This is my first comment, and Nancy, great what you have said. Now, one issue on the climate change. I mean, I think that yes, you're right. All these issues are interrelated. Of course, they are interrelated. Yes, yet climate change is an issue that is globally affecting all of us, and the West, the developed world, we have a duty to use it as leverage to to bring more strength to the World Bank. Also, as it has been said, for more responsibilities, a better attitude, less comfort, just bringing the world bankers out of their comfort zone. But I think that bringing climate change, although it's interlinked, although what I have said may sound contradictory, no, but it's necessary. And you have to take into account energy poverty and the rest. But we need a good narrative about what we are doing in climate change. We don't have it.
Yeah, I think Ajay Banga said it best that I heard him say somewhere. You know, he wants to encourage risk taking, but if you keep making the same mistake again and again, you're going to have to be held accountable. So that seems to be a good way to go. But over to you, Johannes, first. Yeah.
Yeah, I mean, on the risk business, like Anna and to some extent Nancy, although he didn't really talk about that, I think taking more risks in the project and program area, I think, is important. And I think, you know, I think the institutions more generally in the development business have so far gone down the path of not being seen to make mistakes and be seen to have, you know, a dollar here, a dollar there being misused, that, you know, we tie ourselves up in knots. And so that's related to the speed. And I think, yeah, there has to be something has to be done in taking more operational risk. Now, I disagree with you, as we heard, on the broader financial risk issue. Although I'm not, you know, if the shareholders want to increase the risk of a call on capital, then yeah, I mean, then take that risk and be aware that you're doing it. What I object to in the report of the G20 is that it buries that risk. It doesn't talk about that risk. And by the way, IDB, I'm sure, is doing a separate analysis and stress tests on whether there will be could be a call on capital under what conditions. Indeed, I talked to IDB former treasurers, and this is exactly what they're doing. So this uplift that the report says the IDB is doing that others aren't doing is, frankly, is a red herring. It's unrelated to the issue that I'm raising. It's unrelated to the challenge, which is to maintain your callable capital, and that hasn't been yet adequately addressed. So I just want to be sure that I'm not misunderstood. Maybe more risk can and should be taken, but if you do it knowing what you're doing. And I think the report hasn't done us a service in that regard, making very clear what kind of risks are at stake and making very clear when shareholders decide about taking, you know, squeezing the capital, they know what they're doing. Now, on the private sector finance guarantees and so on, yeah, I think, Ajay, you mentioned also, But just a reminder, when we negotiated a guarantee with what was then Ukraine, and still is, thank God, Ukraine, it took ages. Why did it take ages? Not just because our lawyers, pre-Anna, took a lot of time and had a lot of issues. No, the private sector lawyers took forever. And it was not the bank that is slowing us down. It was actually the private partners that slowed us down. So, let's be careful here. Yeah, there are questions about, and I think it's a real question about how guarantees and insurance products can be used more effectively. And I hope Ajay Banga will push in that direction. But let's not presume that there are silver bullets here, because I don't, from my experience, they're not. Thank you.
So I have, that's great. I have two questions. Let me put both of them to you so that we can go one round together. One question is from Johnny McIntyre, who says, panelists have spoken almost entirely of fundraising for climate investment, the liability side of the MDB balance sheet. What do they propose for specific climate mitigation adaptation investments, the asset side, and to improve the impact of those investments? That's one set of questions, one question. And then another question is from Kazumi Homa, who says, can you elaborate a little more on why the World Bank has been reluctant to take international labor migration into consideration, even though it is the reality in low middle income countries? And let me add a rider to this, which is to say, of course, we are well aware of the amount of work that the World Bank has done. I think Dilip Ratha is the key man on this, on remittances, so which are a very large part, by the way. There's more money coming into the developing world in remittances than is coming from all the MDBs combined together. So I've added a little bit to that question, but over to you. Who would like to go first? Maybe Nancy again? Yeah, please.
Yeah, very quickly. Good questions. Why is the World Bank reluctant to take on international migration? Well, it's very obvious. The rich countries have most of the shares in the World Bank. They have most of the influence. Indeed, I suspect, although that's changing in good ways, they still have most of the staff coming from Western institutions, if not being with Western passports. And remittances, I remember when I founded the Center for Global Development, which was in 2001, thinking, sure, remittances, that's safe. That's good stuff. That's very simple and straightforward. It doesn't raise any political issues internally. So the answer is, the constituents, the voters in rich countries don't like migration from poor countries. That's why it's not ever been on the agenda. I think there has to be a big push, including these African voices that Anna correctly raised about this kind of issue. It's a long way coming, but the key is to relate it to new money for climate. We can't have it only for mitigation. It has to be for adaptation too, and resilience. And part of that story will necessarily be helping developing countries cope with their own migrants from other developing countries. I talked about the example of Jordan and Lebanon, so the example is there. On what about adaptation? I didn't say it because I didn't want to say too much, but I think one of the benefits of having a separate green fund that is for mitigation, that can work with the private sector, yes, leveraging some money, although so far I'm very pessimistic about the private sector taking sufficient risk, and probably correctly so. It's not clear that there are enough projects and programs out there in the developing world to attract private sector resources. That's never been clear, and we've never been honest about that. But still, let's imagine we have a green climate fund that focuses on mitigation, and all the resources, all the concessional money should go to adaptation, and by the way, to loss and damage, which is an issue where, again, the US and other rich countries are going to resist and resist and resist the demands of developing countries to think about loss and damage funds when countries are savaged by climate change, when poor countries are savaged by, well, so we have to do adaptation, we have to do resilience, but those with concessional money, that's where the concessional money should go. Okay, thanks.
So, yeah,
I
Johannes,
think,
you still have your hands up, so yeah, go ahead.
yeah, if I may quickly, and Joni asked this question about, so what about the impact and the sort of the liability side? I'm glad you asked that, Joni, because that's been actually what I've been personally much more occupied with in recent years, by looking at how do our many aid dollars that we put in, and it's no longer aid, assistance dollars over the decades, how have they actually not achieved the kind of impact that we all had hoped for? And I think a lot of it has to do with the way they're being provided, namely in relatively short-term one-off projects that aren't part of a sort of a longer-term vision of where you want to go, no pathway to scale of impact that I believe is absolutely critical. And actually, I'm currently in a conversation with our colleagues at the World Bank, who had in their development committee paper a very interesting paragraph 30, take a look at it, actually suggests that the World Bank take a lead and be much more proactive in looking for impact at scale. And I think that's exactly where it has to move and be a leader, because, you know, we know that the space for climate and development finance is incredibly fragmented. The projects are incredibly small. And if we don't find a way to actually bulk them up and have them in some effective way support impact at scale, we're never going to get there, even if we put in another, whatever, billion, hundreds of billions of money. So I'm glad you raised that. I think it's absolutely critical. Thank you.
Well, I could just say amen to what Nancy and Johannes have said, but just to add, I think that what we need now and this is what climate change gives, is transnationality and scale. A good example is grid, for instance. It's what we cannot is just have this fragmentation, this hodgepodge of small projects that in the end add up to big sums of money, but have no long-term, as Ajay, you have said, no long-term results, or not. They don't really change the panorama in the long term. And in that sense, I think having a clearly transnational affair, as global public goods are, as climate change is important. It will give legitimacy. It won't end up the country-oriented projects that normally have a characteristic of urgency, of immediacy. And what we need is to plan for the long term in any aspects, starting with this energy poverty. You have to create, to bring, and this you have to have a regional, even continental approach.
Thank you very much, Anna. So, another question that I had, but I'm seeing more questions come in. Anyway, let me say, the bank has been very much focused for the last probably 20 years or so on a country-based model. And while it has had many advantages, one of the big problems that people now see emerging is the fact that the bank has been less able to work on global and even on regional problems. So how do you see that? I mean, do you see how do you see that being adapted now to the new realities that the World Bank will have to face? Who would like to go first?
I'm happy to go first.
Okay.
And I'll be short. Yes, absolutely. The bank, all the bank's work is founded or on a country-based model. That's a good thing. That makes sense in a world where you're doing country-based lending. Climate mitigation is a global public good. So the country-based model, although the World Bank has tried and done this and that, it's never going to be able to incorporate effectively a mitigation work in middle-income countries where it should be, possibly through the private sector, but in general not. So that's why I think it's a good idea to have a separate fund. That's the end of the story. With dedicated staff, a dedicated management. It's a little bit like when the private sector windows were opened at the multilateral banks.
Johannes?
I agree with Nancy in principle, in the sense that I think the multilateral development banks and bilateral donors, large bilateral donors, I think need to take a leaf out of what I think is really successful model of vertical funds like the Global Fund and so on, that have taken on what I would regard an appropriate impact at scale operational modality. And that involved, among other things, that you stay engaged in countries over the political cycle, even when a particular minister isn't interested in your business. You still engaged, and you actually engaged with the general stakeholders, civil society and so on, and you build capacity over time, and you keep pushing for that particular agenda that you have a mandate for. Now, I disagree with Nancy, I think, but haven't thought enough about it, that setting up a totally separate sort of IFC and IDA and MEGA-like yet another fund organization within the bank structure, group structure, is a good idea. I think that fragmentation actually, I don't think serves the World Bank Group very well for various reasons, and including, by the way, financing by segmenting the financial structure, which I think limits the leverage up to a point. So I would say you need to do that within your operating model, within the way you operate currently, and push for, in fact, for impact at scale in the areas in which you want to focus, such as climate change. So that was what I would recommend. By the way, there is, however, a point, Ajay, that Vikram raised on, so what are the financing terms? Nancy seemed to indicate that she thinks concessionality only ought to go to the poorest countries and for climate adaptation. I actually think that's not the right way to think about it. You have to subsidize global public goods. Otherwise, they're not going to be optimally provided. And indeed, that's what the argument is currently about, that the US, among others, is arguing that the World Bank ought to increase the concessionality of its lending to middle-income countries so that they take up the climate agenda more effectively. So I think we still have some ways to go in clarifying that particular issue.
Just to say, I hope that's not what I said. That's not what I meant, but it may be up.
I'll come back to you, Nancy. You'll have the last word.
Well,
We'll all have the last word, but
no, it doesn't. I am not particularly interested in having the last word, but yes, in underlying that all my intervention has been precisely around this idea that the World Bank needs, in order to address global public goods, needs to transcend this country-focused way of working, and I have said it from different angles. One issue on which we have understood well, Nancy, I don't think that it would be interesting to create a new institution for the reasons that Johannes has said, but for another reason. We need to shake up the bank in total. If you create another institution, and IFC there are instruments in the world to do what IFC does. There are instruments in the IBRD to do what MEGA does. However, the only thing I think that it was natural to create an independent institution for ICSID because of the nature of arbitration. But having said that, if we create another institution, we will just push forward this risk-averse, complacent do it as we always have done, way of doing things at the World Bank. And this is not criticizing. I think that the three of us are very honored to have served the bank. And as I say, it's a fantastic, but the world has changed, and the bank, the structure of the bank has to change, not to create another institution to address the new challenges.
Yeah, I have some sympathy with that because then the troops are told, now you better find ways to work closely with each other and do the, all that coordination and everything. And so, but I do feel that climate change needs to be brought into the hardware of the bank in much more fundamental, holistic ways than creating another institution. But let me go with one more question, which I was coming to on Vikram's set of questions on, mainly also linked to the China issue, which is that as China has found that BRI is not such a great thing, many countries are now rethinking their whole relationship to BRI because of all the debt that has been saddled. And as Vikram says, 2/3 of the developing world is now in debt distress. So how does this work going forward? Now we need new money for climate change. We have a major debt problem to deal with. And of course, China is also realizing that it has to come and play ball because it's saddled with all this. So it's sort of not a question, but a set of interrelated issues now. How does one go forward with all this? Who would like to take a stab at this?
I'll just say quickly, it would help to have a strong, charismatic, exciting, insightful leader at the World Bank.
Yeah. All right.
I agree, and I think that's actually the biggest challenge. I think Ajay Banga is, he's clearly a terrific manager of a large organization. He has a development country background. He understands finance. He understands the private sector. But what's the vision thing? Does he actually have a vision what he wants to do with all those skills? And now this instrument, the World Bank. I mean, Jim Wolfens and McNamara had visions, and for better or worse, but I think overall for better. And they made a huge difference. I don't think the other presidents, most of the other presidents in my lifetime actually did. So the big challenge, I think, for Ajay Banga is the vision thing. And I hope he leads on not just as a manager, but actually as a leader not just for the World Bank, but with the World Bank in the international multilateral space, and especially on global public goods issues, because I think we really have to address those.
Last word, Anna.
Well, I fully agree. I mean, it cannot be better said. I think that Ajay Banga, in principle, has all the right requisites. Now he has to show that all this just goes to a vision, and that the vision is not just, as the other day he insisted on this idea of digitalization, but this is not a vision. This is part of how you materialize a vision. The vision is needed. There have been precedents at turning points in history. Johannes has mentioned two great. I mentioned McNamara myself, and we need that. What Ajay Banga has to know is that we are behind, that the World Bank, present and past, we really need him to succeed.
Well, thank you very much. I think we'll conclude it here. And thank you all. Thank you, Nancy. Thank you, Johannes. Thank you, Anna, for that very rich discussion. Ajay Banga certainly starts with one big thing in his favor, which is he has a great first name. which by the way in our language means victory or undefeatable.
Fantastic.
So
thank you,
and
Ajay
we wish
Chhibber.
him the very best, and I hope some of your ideas, we'll find a way to put it all on video, of course, and it will be available for wider circulation.